Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, January 1st, 2016. This week, stocks ran into a resistance level at a logical level and then bounced back. Also, we'll look at the year in review, and this year has been driven largely by large cap technology stocks and cash, of course. Again, we'll look at comparison of 2011 versus 2015. Then we'll go into a bonds presentation part, and also we'll look at the dollar as it's probably ready to challenge 52-week highs again. So far, gold and gold miners have been locked in a sideways action, and finally we'll finish off with oil and natural gas. All right, let's start off with S&P 500 ETF SPY. This is a daily chart. This week we had, well, the bulls really wanted to see this hammer candlestick play out, and actually we had a hammer candlestick and a bounce higher with a gap up. But then immediately on Wednesday and Thursday we had a pullback, and we actually ended the week with a loss for the week. I've been bearish on the stocks. You can watch some of my videos prior to this. Since probably sometime here, I think I was bearish on stocks. Now, this week we ended below the 200-day moving average as well. So, not something that the bulls wanted to see. We could continue lower, and I think this support from November was already broken here, and we had another close below here. But it's possible that we will get another challenge to these lows and possibly break down and continue lower. For example, this gap up needs to be closed also. Also, you can see that on balance volume, which is a very kind of useful indicator showing volume patterns, has been trending lower for the past 6 months, while we kind of traded sideways and possibly even up here. But I mean, this is not high. But let me zoom out even further out to 11 months, and I'll show you. It's an interesting divergence. You can see that on balance volume actually has been trending lower since last February of 2015 and continued lower and lower. And here, this divergence is pretty obvious. You can see that the index is making higher highs while the on-balance volume is making lower lows. So I think this is a sign of distribution, and it seems to be continuing. All right, let's next look at some of the performance charts for various asset classes. So this is a performance chart going back 1 year from December 2014 until 2015, 31st of December. And this is showing 5 asset classes rather. The US dollar index, the S&P 500, the Barclays bond fund, AGG, gold, and diversified commodities, CRB index. You could argue that you can just group gold together with the CRB, but I kind of like sometimes to separate it into its own class, so I went ahead and separated them out. So you can clearly see that the dollar was the biggest winner this year. This is actually S&P 500 SPDR, so this includes dividends. If we take out the dividends, the S&P 500 was down a fraction of a percent. And this is same thing here with the bond fund. It does include dividends. So one of the tougher years really to invest. If you are like a buy and hold investor, you obviously barely broke even. If you like to play currencies, then you certainly were in a better position. Next, I wanted to kind of delve a little bit deeper into which stock sectors performed better, and the clear standout here is of course QQQ, and this is also with no dividends. You can see that there is this underscore, so all of those IWM they have no dividends in them. So QQQ clearly outsized performance here, very nice. So basically this shows that the market as a whole was driven by large cap technology stocks, and of them probably by just a handful. So not a broad advance. You can see S&P 500 with no dividends actually lost money. The Dow Jones Industrial lost even more, and of course the clear losers were the small caps, the Russell 2000. The very broad New York Stock Exchange Composite lost 6.42% for the year. All right, next we're going to look at comparing 2011 versus 2015. Okay, so if you listen to some of the commentators and like if you read some of the Twitter streams, one of the favorite pastimes this year was to try and compare 2015 to the previous tough period was in 2011, and it does look similar, but I kept saying that actually it looks similar, but it's quite different. And so I showed this chart in the past, and I just want to revisit it again to see if it made any changes so far. So very quickly, we have four indicators here. We have the moving averages, the 50-day moving average and 200-day moving average. We have the new highs, new lows percent indicator. We have the bullish percent index, and we have the percentage of stocks above the 200-day moving average. So if the 50-day moving average is below the 200, then we're going to keep a bearish bias. If the percentage of stocks, new highs, new lows percent is below -5%, we're going to keep a bearish bias until we get a surge above +5%. Same thing here with bullish percent index. If we get a drop below the 40% mark, we're going to keep a bearish bias until we get a surge above 60% mark. And also here, the same thing is for a percentage of stocks above the 200-day exponential moving average. If we drop below the 40% mark, then we're going to keep a bearish bias until we get above 60%. And these are kind of just numbers that that were picked, and they are not necessarily the gold standard, but they're kind of like a good threshold, so to speak, for the bullish and bearish periods. Anyways, here we have all four indicators going into bear mode in August of 2011, and then I'm going to just turn on this inspect button. After this bearish crossover, we had 57 periods before two of the indicators turned bullish. 57 trading days rather, and then another indicator turned bullish, 112 periods right here, and then finally the bullish average crossover happened 131 periods after this bearish crossover occurred. So it's pretty straightforward. In my opinion, this was not a very deep correction, certainly not a bear market, and bear market as would have been defined by series of lower lows and lower highs. None of this clearly happened here. So now let's look at what's been happening in 2015 and compare it to what just happened, what I just showed you in 2011. Okay, so this is a current picture as it stands on January 1st, 2016. We had also same indicators. We have same indicators here on this chart. So we had a bearish moving average crossover here in late August. But notice already we have a different picture. I'm going to go back to 2011 for a second. Here in 2011 we had basically all four indicators turned bearish immediately about the same time. If we go now to 2015, you can see that here the percentage of new highs, new lows percent actually started turning bearish even before this support break and moving average crossover. So this started back in June actually. And the same thing happened for percentage of stocks above the 200-day moving average, also started to happen before this support break and the moving average crossover. So already we can see differences here. Then bullish percent index and moving averages crossed over together at the same time in August. Now, as you can see, so far we have 0 of the 4 indicators I just mentioned going back into the bull mode. We can see that moving average are actually coming further apart from one another. The new highs, new lows percent did not yet exceed plus 5%. So currently we're at 3%. We need to get above plus 5% to turn bullish. The same for bullish percent index. We have not been able to get above the 60% threshold, and clearly percentage of stocks above the 200-day moving average are not even close to the 60% threshold. As a matter of fact, we couldn't even get above 50. You can see here we got below 40 right here, and then not a single reading above 50, you know, for the past however many periods. Let's check. Oh, sorry. So after the moving average crossover, so far we had already about 90 days or so, 90 trading periods. So by now, if I go back to this 2011 period, by now we would have, you know, already 60 days out. We had two of the market breadth indicators already turned bullish, and then another one turned bullish by 111 period. So for now already we're kind of, you know, further out. We're like 93 periods away from the, you know, bearish crossover, and so far not a single indicator has turned bullish. So in my opinion, 2011 and 2015 look quite different, and actually showed my in-house market breadth index. They also looked different than 2011 versus 2015. All right, let's move on to the fixed income universe. This is AGG, aggregate bond fund, kind of like a proxy for the bond market. So I think that for now we have held the support in this 107.50 area, even as recently as this Wednesday. I think for now the support is holding. For the record, I think the bonds are bullish, so I'm looking only for long setups. I'm not looking to short bonds. Especially here, this is kind of like an important area in 108, 108.2 area. You can see that this large volume by price bar. So this is kind of like a large volume resistance area. If we break above this area and close above it, and especially if we break above these highs, I think door will be open to, you know, continue higher and possibly even break above these highs. And you know, if the S&P 500 comes under further selling pressure, the logical place to rotate, of course, would be bonds. And I know that the Federal Reserve is scheduled to rise interest rates, but I think the bonds are driven more by the amount of fear in the market, and you know, if stocks drop, I think the fear will certainly go up. Next, I wanted to show MUB, the municipal bond fund, and it hit another all-time high just this Thursday. So this again is showing that investors are rotating away from the stocks and into alternative asset classes, like for example municipal bonds. You You can see this on balance volume is confirming this move higher, so there's no divergence. Yeah, it certainly is overbought at this level, but at the same time, this is very bullish. If you're hitting 52-week highs or all-time highs, it's quite bullish. So if there is going to be any pullback, I will be looking to enter or add to positions again. Okay, moving on to the currencies world. This is a US dollar index, cash settled daily close of day chart. So several months ago we had a breakout here above this previous peaks, and then we continued almost to 52-week highs. 52-week highs, like we came within just a few cents of the 52-week highs. Then we had a speech by Mario Draghi, this big red candlestick, and then since then, I think basically the dollar held support here in the $97 area and then rebounded, and this is, I think, maybe a throwback of sorts. So if we're going to say that this support is going to hold, then I think the door is open for the US dollar index to challenge 52-week highs again. This is, to me, this is a bullish chart, so I don't normally trade currencies, but if I was trading it, I would be buying it instead of shorting it, in other words. You can see also the STTR, Stock Charts Technical Rank, for UUP, which is a bullish dollar fund. You can see it's at 91, so that's, this is just showing that the dollar is in the top 10% of performance for ETF of all sorts. So next, if we get more upside for dollar, of course, this will weigh on commodities. So let's look at commodities next. Okay, so this is a gold spot price daily chart. I pointed this out before. We had a breakdown here below the multi-year lows. This became a multi-year low, and then we had continuation lower. Now, I was expecting gold to continue even lower and possibly get to about $1,000, maybe even below $1,000. But so far, kind of like the gold bulls and the gold bears are at a stalemate, and it's just really prices kind of moving sideways, basically. We could still break down and continue lower below this lows, or we could potentially bounce higher to maybe above the 50-day moving average, and possibly even around the 200-day moving average. And actually, gold has failed multiple times before the 200-day moving average. So if we do get a bounce, this could present with a nice potential shorting opportunity. All right, this is GDX, Market Vectors Gold Miners ETF daily chart. This is, of course, a very volatile security. It's different than gold itself, but it tracks gold relatively well. So for now, GDX has not been able to break below this $13 area. And just a few days ago, we had another retest of this area and then a bounce higher. Now, for now, we have a lower high being made here. But if we look under some underlying market breadth data, we can see that actually this is a bullish divergence. We can see that the market breadth is actually making slightly higher highs together with unbalanced volume, by the way. So that's, if you're a gold bull, you would definitely want to see something like this. For now, we have not seen a push higher, but I think if this divergence persists, I think we can see a push higher, possibly above this December peak, and maybe even into this area $16, or maybe even higher into this above, around the $16.89 here. Now, this is still very much a bearish security, so this is also quite a wide area of where it could push. But if it does push, you know, and become overbought, then it will present itself as a nice target for short sellers, me included. So you know, again, I'm not looking to go long, only looking to get short because it's a bearish security. All right, this is oil, WTIC West Texas Intermediate, spot price daily chart. So again, you know, a very bearish security, multi-year lows here in December, and then looks like we're rebounding or at least trading higher in this sort of a rising wedge, a rising channel. I think this is a rising wedge because we had a sharp move down, or this could be like a bear flag or whatever. But here was a nice example of a rising wedge working out. You can see it was rising here following a sharp breakdown, and then we had a breakdown of the wedge here and a sharp move lower. Now rising wedge is bullish while it's rising, but if we get something similar to this, I think we could easily see this unfold into another leg lower, even possibly to the upper 20s. For West Texas Intermediate. Also, you can see unbalanced volume is confirming this move lower. So again, this is a bearish security. So if we do get a rebound, maybe to the 50-day moving average, then I'll be looking to short again. Finally, next, let's look at natural gas. Okay, this is a natural gas spot price daily chart. So we had really powerful move lower here, hitting multi-year lows. I think this is like since 1999, I believe, or something like this. It's a very, very powerful move lower. This gap down was suspect to me, and I marked it here as, you know, selling climax question mark. Then following this rebound, I removed the question mark, and this was indeed a selling climax. Now this is a really strong move higher. So if you were lucky enough for some reason to buy at $1.68, then 239 and you sold right there, this is about a little bit over 40% move. So pretty powerful rally. And again, this is a kind of like classic short covering rally. Basically, you get, you know, people covering their shorts and then prices move higher. Now currently I think it's already quite overbought. And also there is resistance here from these peaks. You can see there's quite a bit of trading in this area also here, but even higher resistance level is at 270, 280 here. So if we don't fail here, then the logical next place to go for natural gas would be around here at 260 to 70, 280, and that probably would be a very good area to fail. Again, I'm not looking to go long. It is really difficult to catch a counter trend move. This is a counter trend move. So, and I pointed this out many times before. You know, you could see there was a lot of hammer candlesticks. This is a hammer candlestick. You can see this is a hammer candlestick. This is a hammer candlestick. This is definitely a hammer candlestick. Another hammer-like candlestick, sort of like a hammer, and then this is also a hammer, but it's not really a hammer. Maybe even you can say this is a spinning tap. So in any case, if you're looking for, if you're trying to pick bottom in a bearish security, it's very difficult. So I can try to avoid it, and I just look for a overbought conditions in a bearish security, and I just go short them. We're definitely there, as I said before. So we'll be looking to go short. You know. And then if the security, if a natural gas pushes higher, then this area would probably be even a better place to short as well. All right, that's it for this week's recap. Please stay tuned to see how you can find us on the internet. Thanks for watching. Bye-bye. Okay, I also wanted to show you how to find us on the internet, so please go to MasterChartsTrading.com. We do have trade alert services which are live right now, and it's only $24.95 per month with a 3-week free trial. I think it's well worth the money, and you get timely alerts on when I go short or long, whatever various securities. So I think this is a great value, and my clients have been pretty happy about them so far. We also have a blog here where this information that you're watching will be posted. Also, video section, same thing. You will see the information there as well. If you go to public charts and social page, you will see that we have this link here, public charts page, and this link will open and show the charts that you saw in this video. If you sign up for our mailing list, you get a special discounted price for our trade alert services. If you have Twitter, Facebook, YouTube, or StockTwits accounts, please follow us there as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye-bye.